Recipes for technical trading success in Cook's Kitchen.
What's keeping this bull market on the road? While the bears have a lot of reasons to think that it should go off the road and into the ditch, I'm going to talk about at least 5, maybe 6 linchpins of the bull market. All right, first off, let's talk about 6 reasons to worry that are very common. You know, economic data has been bad. I'm going to run through these real quick. Earnings and valuations. Forward earnings came down, pushes valuations up 18 times trailing, 17 times forward. Price momentum, market breadth, and distribution. The bears could make arguments for all 3 of these being negative. The momentum has slowed down, that's for sure. You've got many distribution days. We just had one yesterday on Tuesday the 26th. Here we are on Wednesday, May 27th. And market breadth. You could look at market breadth from 6 different ways and find something wrong with it. I'm going to counter that, though. All right, what else? Sentiment extremes. I'm going to show you a sentiment chart that shows an extreme. Ray Dalio of Bridgewater and Costin of Goldman Sachs, both very negative, or at least neutral to cautious on this market, and not seeing much further upside with quantitative easing just driving the upside. And then here comes summer. We're going into a seasonally weak period. So a lot of reasons to worry and be cautious about stocks. And yet, if you're a stock picker, you know better. And if you're picking quality stocks, you're doing well. All right, so let's look at that sentiment chart I have. This is from Ed Yardini. He tracks this every week. And this is one snapshot of Investors Intelligence where you're looking at the bull-bear ratio. You know, the percentage of bulls versus the percentage of bears. And you can see up here in this corner, so this is pretty much most of 2013 and 2014 into 2015. Look how many times this ratio gets above 4. This is quite an extreme. Whenever the bull-bear ratio on Investors Intelligence gets above 4, you are talking about an extreme and bullish sentiment. And it's nice to see it drop back down to 3. So last week, May 19th, back down to 3. But it seems to really live above there. During the October correction in 2014, the ratio came down to 2 as we really washed out a lot of bulls, and you saw bearish sentiment climb. So here we are again, living between this 3-4 area. Remember, Investors Intelligence, these are the newsletter writers like me. So, they've been right, obviously, being so bullish. And I think it's because a lot of them pay attention to the same people I pay attention to, and that's the big fund managers. All right, now, what's a linchpin? Obviously, it's a locking pin inserted in the end of an axle to prevent a wheel from slipping off. So that's what we don't want to happen. We don't want the wheels to fall off the stock market. And so I'm going to talk about all the linchpins I see. And, so I have a counter to every bear argument. Yeah, the economy's growth trends may have been weak. We had another harsh winter, a lot of bad data. Retail sales still hadn't come back. The PMI numbers have been weak, but housing's strong. So, smart fund managers are looking forward out another quarter, 2 quarters, 3 quarters, and they see the economy still just chugging along, what Brian Westbury calls the plow horse economy. And I believe that to be true. We'll look at a few other economic indicators coming up. All right, interest rates, they're still on our side. Earnings and valuations, hey, in this bull market, we're not at a peak yet, so we can play around between 16 and 18 times forward earnings, and that's fine. And as far as price goes, hey, the trend is still positive. Market breadth is solid, and cyclicals. I mean, look at, you've got consumer discretionary and technology still, driving strong. And if the economy and the market were really in trouble, the cyclical stocks would not be leading. It would be staples and utilities, and they're not. All right, consumers. Consumer confidence is high. Jobs are growing. The spending is there. We talked about confidence. We're going to come back to consumers in a minute. Lastly, whale thinking and M&A. This is something I follow. What do the fund managers think? Some of them are economists. Some of them are, make it their business to to make forward projections about the economy and be stock pickers at the same time. And their thinking is that, hey, they're still buying select stocks and trying to hold them for a few years. And M&A just keeps growing. We're going to, in 2014, there was $1.5 trillion in M&A. We're already in May, actually as of April, we're already at the halfway mark. So 2015 is going to probably top, based on that run rate, top 2014 on M&A. All right, so let's take a closer look at the consumer and jobs. This is from Tom McClellan, and what he does, I showed this chart in a blog last week. He flips over the unemployment rate and plots it against the University of Michigan Consumer Sentiment Index, and then he shifts that forward. So he takes U of M sentiment, shifts it forward 10 months, and he looks at this data going back to 1955 and says it's very predictive. So, the unemployment rate is going to keep trending down, and that's strongly correlated to consumer confidence. So something you want to take a look at on McClellan's site. A couple other ways to look at sentiment and optimism. This is the National Federation of Independent Business Survey. So this is small business optimism. And, so this is going back to, whoops, skip the chart ahead there. This is going back to the June of 2011. So 4 years ago, the Small Business Optimism Index was just kind of bumping along, pivoting around 90. And then we had a really strong breakout in 2014, and now it appears to be living up in this area. Now, so this is another way of looking at business confidence. This is not the PMI, purchasing managers of large corporations, and it's not consumer confidence. It's the small business owners, and they're looking at, this is a statistically robust survey where they're asking them, key questions. What are your plans to hire, make capital outlays, increase inventories? What are your current job openings, expected credit conditions? So all these things. So that's why I like this survey too, to give you a rough idea, taking the pulse of small business, which employs, 2/3 of the American workforce. All right. This is from Tom Asprey, and this is looking at leading economic indicators. Another favorite of mine. And what's the trend here? Hey, there's no slowdown right now in the leading economic indicators, and they are very strongly correlated. There's never been a recession when leading economic indicators were still pointed up. All right. We're going to take a look back at some charts I showed you back in March. Hey, how old is this bull market? This is actually from 2013, when the current bull was only 4.5 years old. Well, now it's past 6 years old. So how does that look in history? It's getting old, relatively speaking. But we have to remember, bull markets don't die of old age. They usually die of a recession first, and or an inverted yield curve, which can tend to be associated with one another. I also showed you this chart a couple of times this year. This is looking at economic expansions going back to 1854. So the current economic expansion is, we just became the 5th longest at 72 months, and this one is on its way to taking out the 4th longest at 80 months. So by March of 2016, if things go as smoothly as they are now, the plow horse economy, which I think it will, no signs of recession, then this will become the 4th longest expansion at about 81 months in March of 2016. And as long as that's the pace and the trend, the bull market continues. We'll talk about my recession indicator in a minute. First let's look at this. This is from LPL Financial, and they're just looking at 5 key forecasters, so to speak. What's the Treasury yield curve doing up on top there? If it's inverted, obviously you got a problem. There's LEI again, market breadth, PMI, and then PEs. So those are 5 of my favorite metrics to look at, to ask yourself, what's the probability of recession? My recession probability indicator adds 5 more elements to this, and then I weight them and score them. And as recently as last month, I came up with a 17% chance of a recession in the next 3 to 9 months. Now that's significant to me because that was a jump of 10 points from the fall. In October, I was at only a 7% chance of recession, and now I'm just under 20%. Now I get worried, or I get concerned at least, when my recession probability gets over 20%. We're not there, but we had to be concerned with the weak economic data, the decline in earnings, and the strong dollar. Because that strong dollar, if it's forecasting higher interest rates, it just keeps pushing against exporters and manufacturers. All right. So again, bulls don't die of old age. They die of recession. They die of excess in PEs, of euphoria, when everyone loves stocks. And think about where Fed funds is going to be a year from now. Let's say the Fed, let's say they start liftoff in June. Even if they do, they're going to go slow, and so we could see 1% Fed funds a year from now. Still extremely accommodative, and you still have the possibility of the great rotation finally happening, where money comes out of bonds and goes into stocks. So these are my linchpins of the bull market right now, and why I see it continuing. And you want to look for opportunities. Hey, if we get a nice correction this summer, which is certainly possible, 5 to 10% correction, I think you want to step up and be a big buyer of that. All right, I think that was my last chart. So got through that pretty quick, 11 slides and hopefully 11 minutes. All right, thanks for joining me in the kitchen. We'll see you next week.